Okay, let's dive right into this explainer. Today we are completely tearing down an 85-page scheme information document for the brand new Franklin India short-term fund. New fund offers always generate a ton of hype, so we're going to cut through all that heavy financial jargon and distill exactly what you need to know before you even think about putting your money on the line.
So let's start with a really crucial question. When inflation is just eating away at your cash like a teenager at an all-you-can-eat buffet, where can you safely park your money for a short 1 to 3 year timeline? It's a tricky sweet spot, right? It's too long for a basic low-yield savings account, but it's entirely too short to risk heavily in the volatile stock market. Well, that's the exact financial gap this new fund offer is attempting to fill.
To make this painless, here is our roadmap for today. 1. Unboxing the fund. 2. Where your money goes. 3. Meet the managers. 4. Navigating risks. And finally, 5. The price tag.
Let's kick things off with Section 1, Unboxing the Fund, and see what exactly the Franklin India Short-Term Fund is all about.
Now, this brilliantly illustrates the market standard for this category. Measured by its benchmark, the NIFTY Short Duration Debt Index, it sits comfortably at a low to moderate risk level. So going in, this is your baseline expectation for short-duration debt.
But check this out. Notice the slight bump in risk here? The scheme itself is actually rated slightly higher at a moderate risk level. You might be wondering why. Well, it's because this is an actively managed strategy. The managers aren't just blindly replicating an index. They're out there making active bets to try and outperform it. Moving on to Section 2, Where Your Money Goes. Let's look right under the hood of this portfolio.
The real engine of this fund is a metric called Macaulay duration. Now, don't let the term intimidate you. You can simply think of it as a lease agreement that runs strictly between 1 to 3 years. Technically speaking, it's the weighted average time it takes for you to receive all the cash flows from a bond. But the key takeaway? The fund's explicit mandate is to construct a portfolio where this duration stays tightly boxed within that 1 to 3 year window.
If we look at the strict asset allocation limits, you'll see the bulk of the money goes to standard debt and money market instruments, things like commercial papers and treasury bills. But look closely at the other limits here. Up to 50% in securitized debt, up to 100% in debt derivatives. That is a massive allowance. It gives the managers incredible flexibility, but let me tell you, it demands serious expertise to pull off safely.
So here is the crucial takeaway from all of this. By design, this portfolio takes on moderate credit risk, but relatively high interest rate risk. What does that mean for you? It means they aren't going to go wild buying up low-quality junk bonds, but they're perfectly willing to expose your money to general interest rate fluctuations to chase those higher yields.
Which brings us to Section 3, Meet the Managers. Let's look at the engineers actually driving this strategy. Here's the thing about new fund offers. There's absolutely zero historical performance to verify their specific strategy yet. None. You can't look at a chart to see how they did last year. Instead, you're placing your trust entirely in this highly experienced trio. With Rohan Maru, Anush Tagra, and CIO Rahul Goswami, you're looking at decades of institutional fixed income knowledge meant to navigate complex economic cycles. You're buying their resumes, essentially.
Next up is Section 4, Navigating Risks, because we really need to talk about what could go wrong.
Think of interest rate risk like a giant seesaw. When general interest rates in the economy go up, the prices of the bonds already sitting in your fund will fall. It's just how the math works. You also have to consider liquidity risk, which is especially tricky for NFOs that are trying to deploy a massive, sudden influx of cash efficiently at market highs, and of course standard credit risk, where a corporate bond issuer might just flat out default. Furthermore, remember those huge allowances we talked about? What happens when you use heavy derivative hedging in securitized debt? You introduce complex mispricing hurdles. While tools like interest rate swaps are fantastic for hedging against that interest rate seesaw, they are leveraged. If market conditions suddenly become highly volatile, unwinding those complex positions can become a real headache for the managers.
Finally, let's hit Section 5. The price tag. What does it actually cost you to invest? During this new fund offer, units are priced at a flat 10 rupees each. But beware. This is a classic psychological marketing trap known as the anchoring bias. A 10 rupee starting NAV does not mean the fund is cheap, and it definitely doesn't mean it's on a discount compared to older funds. It is literally just a starting mathematical face value. Do not let FOMO drive an impulsive decision just because the entry price looks low.
Now here is a major highlight. The exit load is 0%.
Meaning, if you need your money back quickly, it won't cost you a penalty fee. This 0% exit load is absolutely fantastic for a short-term fund because it ensures your liquidity isn't held hostage by punitive redemption fees if your financial plans suddenly change.
But operating the fund isn't free. The base expense ratio is capped at up to 1.85% for the first 500 crores to cover management and administrative costs. Now, the good news is, as the fund successfully scales up and brings in more assets beyond that 500 crore mark, regulatory tiers dictate that this percentage fee will actually drop. So you get to leverage economies of scale over time.
And remember, choosing the direct plan means lower expenses for you right out of the gate, since you aren't paying a middleman's commission, unlike the regular plan. Over a 1 to 3 year compounding period, saving even a fraction of a percent on that expense ratio by going direct can have a very real, meaningful impact on your final take-home yield.
So I'll leave you with this final provocative thought to consider. Do you actually have a category gap in your portfolio that requires this highly specific 1 to 3 year tool right now? Or, given the complete lack of a track record for this NFO, is the smarter strategic move to enforce a strict wait period? Maybe let the fund trade for a year or two, let the managers prove their complex derivative strategies actually work, and then decide. Don't let the marketing hype dictate your timeline. Make the fund prove its worth to your portfolio first.